All right. Hello, everybody. Welcome to another weekly edition of Taxes in Retirement Live. Oh, there it is. Yes, I am Andy Panko, owner of Tenant Financial. We got a special one tonight. I'm super excited. I'm joined by a fellow professional friend of mine, Kerry Peabody. Hello, Kerry.
Hey, Andy. How are you?
Doing well. Yourself?
Good, thanks.
So Kerry is a long-term care insurance specialist from Clark Insurance in Maine, the beautiful state of Maine. So Kerry and I know each other. We are acquaintances through the Financial Planning Association, which is the nation's largest network of financial planners and related businesses and services. We've come across each other in the virtual world many times, and I've seen a lot of his content and comments about long-term care, and was like, this is the guy I want to talk with for purposes of doing a long-term care insurance themed show, because I am not an expert in it. So thank you, Kerry.
Sure.
So briefly, before we get going, just the disclaimer: this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither Kerry nor I are. We are just two people here rapping about long-term care tonight. Ain't that right?
That's right.
So you know what I do, Kerry, right? Dad jokes.
Oh, yes. That's why I'm here.
That's why everybody comes. So I wrote a song all about tortillas. Come to think of it, it was actually more of a rap, you know? All right, they get better, I promise. Or maybe they don't, but still, I'm going to read them anyway. I honestly didn't think that my father would steal from his job as a road worker. But when I got home, all the signs were there. There's a stop, there's a yield. And, Kerry, I just got to tell you, I want to give a shout out to all the sidewalks for keeping me off the streets.
Okay, we're done now. I can't top any of this.
Going home. Let me close my camera. It's over. Yeah. Thank you. So Kerry, maybe tell us a little bit about yourself briefly.
Sure. I'm an Air Force vet. I've been in the insurance business now for a shockingly horrifying 25 years. All of that spent primarily focused on long-term care.
Okay.
I was a long-term care medical underwriter, so I was that poor guy behind a desk who got to read 73-year-old women's medical records day after day. That wears on you after a while.
Yeah.
Then I was a national sales director at Unum, and I flew around the country training agents about long-term care insurance and need. Okay. And for the past 17 years, I've been sitting across the table with families and business owners and helping them plan for this.
That's awesome. And you have the CLTC designation, right? Can you just give us a brief little spiel about what that is?
Sure. It's certification in long-term care. It's just a course a designation that a lot of agents will use when they will really want to get immersed in the whole long-term care business, because it's a complex need and it's a complex product, and you need some specialization. Yeah,
definitely. Okay, so just for everyone watching at home, feel free to drop your questions, in the comments section. Kerry and I are just going to kind of, chat about, explain about long-term care. Well, mainly he is. I'm just going to kind of sit here and listen. But feel free to drop in your questions along the way. I will lace them in as they seem to make sense. All right, so maybe best place to start, just super high level, what is long-term care insurance?
Sure. So long-term care insurance, Andy, kind of fills in the holes that Medicare and health insurance won't take care of.
Okay.
Medicare does a really good job of paying for nursing home care if you break your hip and you need 5 weeks of skilled rehab, but that's really all it's designed to do.
Yeah.
Medicare will pay for some home care if you have a surgery and you come home and for a few weeks you need the visiting nurses to come in and change dressings and stuff like that. But it doesn't pay for what's known as custodial care.
Okay.
Custodial care is the kind of care you need when you get up and you need help doing the things that you do every day, like bathing and dressing. Mm-hmm. If you need somebody there with you when you're getting in and out of the shower and pulling your socks on, that's long-term care. Okay. It's also custodial care, and Medicare doesn't pay for that. The other type of long-term care is supervision because of a cognitive impairment. About 60% of all long-term care benefits are paid for people with cognitive impairments. That's Alzheimer's and senile dementia. Okay. If you just need somebody there with you to keep you safe, Medicare's not going to pay for that. So that's what long-term care is.
And the defining triggers or activities or lack thereof that qualify as, okay, I need long-term care are what?
So in the past, before tax qualification kicked in 1996, there were a lot of different ways to go on claim. But today, every tax qualified long-term care insurance product out there uses the same benefit triggers. Okay. I need substantial assistance with 2 of 6 activities of daily living. The activities are bathing, dressing, feeding, toileting, transferring continence. Forget everything but bathing and dressing, because 99 times out of 100, That's what puts people on claim. I need substantial assistance with bathing and dressing. Substantial assistance doesn't mean that I have to have somebody give me a sponge bath and dress me. It means I need somebody there with me while I do it so I don't get hurt.
Okay.
Really important point. You don't have to be sick. I don't have to have a diagnosis of Parkinson's. I don't have to have had a stroke. I might just be 87. And because I'm 87, I'm frail and I need somebody there with me.
Okay.
So that's the physical way to go on claim with long-term care insurance. The other way is if I need substantial supervision. And again, that's because I've got some sort of a dementia issue or I had a head injury. Doesn't matter how you got there.
Yeah.
I'm cognitively impaired to the point where I need supervision.
Okay. And are the definitions of these qualifying triggers, daily living, are they standardized across all insurers, all products, or
every tax qualified long-term care insurance product? Now that includes traditional standalone long-term care. It includes the hybrid products that are filed as long-term care products.
Okay.
It includes long-term care annuities. There are some life insurance products out there that have what we call chronic illness riders. And that's kind of the Wild West. Those aren't held to the same standards that real long-term care products are.
Interesting. And what, can you just back up? What's the tax qualified differentiator you're mentioning?
Sure. So tax qualified policies, again, came around in 1996. They all have to use the same contract, the same basic contract wording with specific consumer protection features. They have to use the same benefit triggers. You get some potential tax deductibility on the front end. Okay. Although that's fairly limited. But the important thing there, Andy, is if you go on claim 26 years from now and you're getting, reimbursed $2,600 a week for long-term care, that's not taxable as income.
Got it. And so pre-96 were policies.
Pre-96, again, it was a different world.
Okay. Are there still? I mean, I guess there may be, but sounds like for the most part, anyone who buys a policy today will be tax qualified.
You'd have to work really hard to find a policy that wasn't tax qualified.
Got it. Okay. Interesting. So here, some pretty general questions, and maybe we'll get to these in indirect ways. A question from Tressa Wood. Oh, never mind. Sorry. That's a question about the technology of the video. Sorry. I meant this one. David Folts, what is the ideal age for applying for long-term care insurance? So we didn't get to the dirty details yet, but thoughts about this, Kerry?
Sure. The day before you have your stroke. I mean, that's the perfect age. So, yeah. Most people are doing it between 55 and 60. Okay. Now, I bought mine at 40, but I'm in the business. Okay. I understand the need and I can't go and talk to clients about something I don't believe in. So I've had it forever and it's dirt cheap. And that's a good thing. You want to do it before 65, if at all possible. You can do it all the way up to 79, but the longer you wait, the more expensive it's going to get. And the more likely you are to have medical issues that are going to keep you from getting covered.
Now, is it like life insurance in the underwriting where your age is it's black and white? You hit this next age threshold, it will be higher, or is it all facts and circumstances about health issues and whatever?
No, it's age banded. So if I'm 56, I'm going to pay more than I pay at 55. Now the big jumps are probably at 55, 60, 65, 70, but it's going to get more expensive every year if you put it off. Okay.
And so 55 to 60, you said, and why is that the sweet spot?
Because people they've built some assets. They're starting to think about retirement. They've got this big gaping hole in their retirement plan that is, what if I need long-term care? And they're talking to people like you about it.
Okay. Interesting. Now, is there a point where, so you got yours at 40, is there any special discount or reason to do it other than kind of, you want to have it, know how it works, have it for yourself if you're going to sell it? Why not 50? Is there an age where it's too young, where you kind of, even though the premium's cheaper,
sure,
you're spending a lot more of it over time versus,
you want to make sure that you've got your other, let's say, age appropriate priorities taken care of first. If you come to me at 35 and you don't have any life insurance, I'm not going to tell you long-term care insurance.
Okay. Yeah.
So it really, I have 40-year-old, I had one woman who had to wait to turn 40 to buy the product she wanted to buy. But she and her husband were very successful financially. They didn't have any children, didn't plan on having any children. So it was a good time for them to get it out of the way. So it's all situation dependent.
Okay, great. Who are the providers of long-term care?
Good question. When I started in this business, there were nearly 100 companies that would sell you a standalone long-term care insurance policy. Today, there are maybe 10. Wow. Mutual of Omaha, best product on the market, very experienced carrier. National Guardian Life is a good, solid carrier. They've been in the business about 6 years now.
Okay.
Thrivent, Fraternal Society, very good, solid company. Those are really the sort of ones that are available through any agent or any independent agent. Then you've got proprietary companies like Northwestern Mutual, New York Life. But on the traditional side, there aren't more than 9 or 10 carriers.
Wow. Now, maybe this may answer some future questions people have, but can you walk through the basic features or structure of the most plain vanilla example of long-term care insurance you can?
Okay, sure. Well, there are really 4 key parts to a long-term care insurance policy.
Okay.
All right. Life insurance is pretty simple. This person dies, this person gets a check. All right. Long-term care's got a ton of moving parts. These are the only 4 that really matter. I'm getting this right and left thing screwed up here. Okay. These are the 4 things that you pick and choose when you buy a policy that control how much you can get out of the policy, and just as importantly, how much it's going to cost. Okay.
Yeah.
The first thing you're going to choose is your benefit amount. If I go on claim and I need long-term care services, how much can I get out of my policy every day or every month to pay for those services?
Okay.
Second thing you're going to choose is a benefit period. If I go on claim and I need long-term care services, how long will my benefit last? Okay. Now, for traditional policies, that's a little bit misleading, if you will, because what you're really buying is a pool of money and their reimbursement products. So let's say I buy a policy with $100 a day benefit and a 3-year bucket of money. Well, if I do the math, what I really bought was a bucket of money of $108,000. Okay, 365 times 3 times $100 a day, that's $108,000.
Okay.
If I go on claim and I use the full $100 a day, every day, day after day after day, my pool would be empty in 3 years. But if I'm receiving care at home and I'm only using $50 a day, I'm leaving $50 a day in that pool, so it could last as long as 6 years. So what you're really buying is that bucket of money. Okay.
Got it. Yep.
So benefit amount, benefit period. Then you buy, they call it the elimination period. It's very foreboding. It's your deductible. You get in a fender bender with a car, you pay the first $500. With long-term care insurance, how many days am I going to be on the hook for my own care before my policy will kick in?
Okay.
Average today is 60 or 90-day deductible for most clients. Okay. And then because you're buying this in your mid-50s, most likely, and you're not going to go on claim, well, we hope you're never going to go on claim, but if you do, it's likely to be 20, 25 years down the road. You want to put some inflation protection on that policy. So both your benefit amount and your benefit pool are going to increase automatically every year because care gets more expensive.
Got it.
So those are the 4 key building blocks. There are a ton of riders. Most of them are trash. Okay. The only rider that I sell on a pretty consistent basis is shared care. And just lets a husband and wife or a couple combine their benefit pools. If one of them uses up their entire bucket of money, then they can dip into the spouses.
Oh, great. Okay. So that's something worth considering then.
Absolutely. About 75% of the clients I work with, the couple clients, do shared care.
Okay. Now, I'm sure this is all over the map, but can you give, to the extent there are averages, like what is the average benefit amount, benefit period, elimination period? You said 60 to 90 days typically.
So I can give you that, but let me explain how I come up with that. Okay.
Yeah, please.
First of all, for everybody, if you want a really good resource to look up how much care costs in your area, go to genworth.com. Okay. Go to genworth.com, click on the aging and you, and then cost of care. And it'll tell you in your city, in most cases, how much care is going to cost you today and how much is going to cost you 10, 15, 20 years from now. So it's a really good tool. All right. So I usually use that if I'm working with clients for, say, in California, I'll go look how much care is going to cost in their area, and I'll use that to build their plan. Now, an average plan for me, Andy, isn't built around nursing home care. Okay. Because most people receiving long-term care benefits aren't in the nursing home. They're either at home or in assisted living. So I usually build the plan as a safety net, and I wrap it around a home care need typically. So an average plan for me is maybe $4,500 a month or $150 a day. Okay. Typically a 3-year benefit period, 90-day deductible. So you're on the hook for the first 90 days. Okay. And usually a 3% compound inflation rider these days.
3%. Wow. Okay.
3%. Yep.
I would have expected those are 1 to maybe 2. 3% sounds fairly good, actually.
Yeah, 3% is still pretty generous, but we don't know, what's going to happen with care costs. So I'd rather,
Yeah, and we were discussing before we went live that when I do modeling and projections with clients, I assume 5% annual increase indefinitely for all medical and long-term care expenses.
Right.
And you had mentioned you think at least the last 5-6 years or so prior, about 4%-ish is more the average.
3 to 4. You're going to have ups and downs, naturally, but 3 to 4 I think is going to work pretty well for most people.
Okay, great. There's some slightly particular questions here, but can long-term caregiver prepare meals for the person?
That's an excellent question. I'll use my mother-in-law to answer that question. My mother-in-law became the poster child for long-term care benefits, okay? She had 2 long-term care insurance policies, and doofus long-term care professional here kept telling her she's got too much coverage. Thank God she didn't listen to me, because she wound up, again, a long-term care poster child. She was in a skilled nursing facility for a little over a year, learning to walk again, and then she received 24/7 home care for almost 2 years. So when her caregivers were at the house, the whole bathing and dressing thing that triggers the policy benefits, that's a very small part of what the caregiver is doing while they're there. She couldn't be left alone, so the caregivers would come in and they'd do the whole bathing and dressing thing, and that would take an hour and a half. The rest of the day, the caregivers were running to get groceries, they were cooking meals, they were doing chores.
Okay.
So all of that stuff, that's even outlined in the policies today, homemaker services. Now, you still have to have those basic triggers, but once those triggers are there, the caregivers are doing a lot of different things.
And how restrictive are the insurers? Like, do they play games? Like, no, we don't think you really need help getting out of bed or dressing yourself.
Right. Excellent question. So think about this. If we're talking about disability insurance, and if I can go on claim and just get a check for $5,000 a month instead of going to work, that's a pretty good incentive.
Yeah.
It's not a very incentivizing event to have people come into your house and bathe and dress, right? So, the carriers are going to verify that, yes, Ethel does need the care, but it's a fairly user-friendly process. Now, where they can be restrictive, and I mean restrictive in the broadest sense of the word, is with traditional long-term care insurance policies, you're going to have to use either a licensed home health care agency or a licensed independent professional.
Okay.
They're typically not going to pay you to pay a child or a neighbor to provide your care. Some of the hybrid products will do that, but that's a different model.
Okay. And do they, so not like, not just a random friend, but spouse, other relative, they typically wouldn't qualify as a caregiver in this case?
Not traditional, right.
Okay.
Not standalone long-term care. Yep.
I guess this will depend as well, but regarding elimination period, so this is a 60-day elimination is if you do have a qualifying long-term care event, you can't do 2 of the 6 activities. Right. You're on the hook for the first 60 days, for example, of paying. After the 60-day elimination policy, coverage kicks in. Right. Just sort of like orders of magnitude, can you give any color as to like whether you go 60 days or 180 days, for example? Right. How does that impact the premium?
So I can show you a policy with a 0-day, a 30-day, a 60-day, a 90-day, a 180-day. Okay. Most people are going to wind up in the 90-day, and I'll explain why in just a minute. If I show you a 0-day elimination period versus a 90-day elimination period, the cost is probably going to come pretty close to doubling. Okay. Because remember, there are a lot of people that go into the nursing home for 5 or 6 weeks for skilled rehab. Okay. Yeah. Okay. Thousands and thousands compared to the people who are going to be in there for 90 days. Okay. Yeah. So most people are going to wind up in a 60 to 90 day. A lot of people say, well, what if I buy a 180-day elimination period? Okay. I'll absorb an extra 3 months of care expenses if it really takes my premiums down. There's probably no more than 10% difference in price for a plan between a 90 and a 180-day elimination period, because they know if you're there 90 days, there's a pretty darn good chance you're going to be there in 180 days. Okay. So everything's geared towards that. The short front end stuff is where the carrier's real risk is. Got it. So yeah, I guess 0 to 90, big difference. 90 to 180, not a big difference. It's probably being penny wise, pound foolish at that point. Yeah, right. So, exactly. Because if I go on claim in 20 years, a nursing home costs $15,000 a month. Yeah. I've taken on an additional $45,000 of risk to save myself $300 a year. Yeah. Okay. Got it. And what is, anecdotally, I thought it was like 2 years or so. What is the average stay or average duration of needing long-term care? I hate that question, Andy. I guess there's a different in-home versus in-facility as well. Well, see, that's it. People grab this. First of all, statistics are pointless. They're useless. Ignore them, especially when the guy across the table says 70% of people are going to need long-term care. Kick him out of the house. It's a lie. Okay, it's not true. Okay. My joke is 60% of statistics are made up. Yeah, exactly.
Think about that.
Yeah. So the average nursing home stay is 2.5 years. Okay. Again, that's thousands and thousands of little old ladies who break a hip and spend 5 weeks in a bed. Okay. And it's 3 poor people who don't have any family around and they have Alzheimer's and they spend 8 years in the nursing home.
Okay.
So it's really misleading. But again, most people on long-term care claim aren't in the nursing home, they're at home. Now, if you go to like a website, say the Family Caregiver Alliance, and look at some of their statistics, they're going to tell you that the average family caregiver provides 4.5 years of care. Okay. So in my mind, if I put a client in a plan that's going to do a pretty good job of covering the cost for most home care scenarios, and we give them a 3 or a 4 year benefit period, we're going to help them with all but the absolute worst case scenarios.
Okay. Right. Worst case being like those 7-8 year
Yeah.
tail event.
Right.
Okay. Got it. What health issues prevent you from being approved for long-term care?
Another excellent question. Okay, everybody listen closely. I'll deny I said this, okay? Do not go to your doctor and say, gosh, doc, I'm concerned about my memory until after you buy your long-term care insurance, okay? 60% of long-term care insurance claims are for cognitive issues, and they are hideously expensive claims. So until you get your long-term care insurance, then go tell your doctor your memory's going, okay?
Okay.
So what will keep you from getting long-term care insurance? If you're an insulin-dependent diabetic, it's going to be next to impossible to get traditional long-term care insurance, but there are some other products you might be able to get. If you, again, memory issues, if you've got severe rheumatoid arthritis, anything that limits you in any way on a daily basis from doing your normal daily activities, the underwriters are going to look at that and say, yeah, this is just going to get worse as time goes on. Okay. Yeah. Comorbidity. Maybe I've got type 2 diabetes and I might be okay, but I'm also 50 pounds overweight and I smoke. Well, again, you're going to make it really tough. Respiratory issues like COPD, if you're still smoking with COPD, not going to happen. Okay. So it's really chronic health issues.
Got it. So you mentioned like type 1 or even type 2, dependent on insulin, probably not a good shot getting traditional policy, but there's alternatives. This may dovetail nice into this question. Maybe this is where you're going. Pros and cons of regular versus hybrid. And I don't know what Moneyguard is, but is a hybrid a possibility for someone that is insulin dependent or otherwise not qualified to get traditional?
Maybe. Again, insulin dependent type 1 diabetics is going to be tough for any long-term care product. Okay. If I'm an insulin dependent diabetic, I may have better luck going with a life insurance policy that has a chronic illness rider. Okay. Now, that's not a tax-qualified long-term care product, but you can get money out of the life insurance policy to pay for long-term care services. But the benefit triggers are different, and more importantly, the benefits can be very vague. Okay. Because you're accelerating the death benefit, you don't have a fixed benefit, so it gets kind of nasty. And I could talk for an hour about that and still not answer that question. But you know, I've had a person with MS who couldn't get any of the traditional or the long-term care products, who I got one of those life insurance policies with a chronic illness rider. So you got to know what's out there. There are also long-term care annuities that are also more liberal on the underwriting. You might be used as a last resort. Okay. As far as pros and cons of regular long-term care versus hybrid, oh goodness, that's a 3-hour conversation. Most efficient way to buy true long-term care protection every time is going to be standalone traditional long-term care insurance. Okay. The downsides to that, what if you never need long-term care? Well, hurrah. Okay. You don't go to bed at night and roll over to your spouse and say, you know, honey, I wish the house would burn just once. We've paid all this money for house and homeowners insurance. You don't buy it hoping you use it, but some people get hung up on that. Yeah. Well, hybrids, you know, something's coming back no matter what, either the death benefit, long-term care benefits, some of both, or a surrender value. Okay. So that's the upside. The downside is they cost more because the carrier knows they're paying something back. Yeah. So the general sort of consensus I get towards insurance products that try to be all things to all people is they do everything sort of well, but nothing really well. Does it kind of dilute their value and benefit when you start clumping together all these different? Oh, sure, definitely. Like you said, anytime you've got one tool that's trying to do 5 or 6 different things, it's like the Ronco, Colostomaster. It doesn't do anything really well, but it does a lot of different things. Yeah. The hybrids are good products. I sell a lot of the hybrids. You've got to be a little bit in a little bit stronger financial position for the hybrids to make sense. Okay. But what's really good about some of the hybrids, Andy, is they pay a cash benefit instead of a reimbursement benefit like the traditional long-term care. if I've got a traditional policy with a $10,000 a month benefit and I'm using $2,600 worth of care, I get reimbursed that $2,600.
Okay.
If I've got a hybrid policy with a cash benefit and I've got a $10,000 a month benefit and I go on claim, I'm getting a check for $10,000.
No matter how much you're actually spending.
No matter how much my expenses are. And if I want to pay my daughter $5,000 a month to hang around and help provide care, I can do that. So you have a lot more flexibility with those products.
Now, is that, so the traditional sounds like it's mostly what's called reimbursement, right? You only get the benefit to the extent of what you actually paid in care.
Correct.
The other name, did they change that? I thought it was indemnity or something along those lines.
Cash, indemnity, same thing.
Okay. So as long as you have any service, you'll get paid the full sticker amount of your coverage.
As long as you're still eligible for benefits for the full month, you're going to get the full monthly benefit. Yep.
Got it. Now, do traditional policies not have that, or it's just less common or more expensive to do?
Way back when, Unum had a total home care policy that would do that, but no, there are none. Mutual of Omaha right now is the best traditional product on the market, and it'll give you a 25% cash benefit, but it's very limited.
Okay. It's kind of timely, I guess. So given that the industry has consolidated so much, how likely is it that the companies you mentioned, those 10 or so, are going to be there in 20 years?
Again, great questions. You've got a great audience.
They're
this
sharp.
is the same thing, and you may or may not know this, Andy, but what's happened to long-term care over the last 25 years is the same thing that happened to disability insurance in the 80s. You had a bunch of carriers that jumped into the market and started selling benefit-rich plans to get a foothold and really build big market share, and then they realized, oh my God, this isn't for us. We don't want to do this, and they got out. Now there are 10 companies that sell disability insurance.
Yeah.
Same thing with long-term care insurance. You have to make sure you're working with good, solid companies. That's why you work with an agent who understands this stuff. You do not work with a B-rated carrier for long-term care insurance. Don't do it, okay? You work with carriers that are conservative underwriters. There are only 2 insurance companies that sell long-term care that have gone under. Those were both carriers who said, if somebody else declines you medically, we'll take you. Come see us. Okay, so work with solid, A-rated or better. Work with companies that do very good conservative medical underwriting. And if the carrier you're looking at is priced at 60% less than everybody else, that tells you there's going to be an issue with that carrier. Okay, so you can find good companies. Put yourself in my shoes. The last thing I want to be doing when I'm 75 is taking calls from my 90-year-old clients, and they're asking me, "Where'd my insurance company go?"
No.
So exactly. So.
Okay. Now, is it true? I heard that part of the reason there's been premium increases is partly because too many people got in, either didn't know what they were doing or undercut themselves, and underestimated the actual cost of or usage of benefits. And in order to stay solvent or at least keep the products viable, regulators have required them to increase premiums. Is that true?
The regulators won't call the insurance company and say, "Hey, Genworth, you want to raise your rates?" But they have to take all that into account when they get a rate increase filing. I guess I'm going to back up a little bit. So if I get a little bit long-winded here, rein me in, Andy. Okay. Sure, Life insurance has been around for centuries. Annuities, centuries. Long-term care insurance has been around for 45 years. All the carriers recognize the need, but they used a lot of the same pricing assumptions they used for life insurance and annuities when tackling long-term care. And it's an entirely different risk. They didn't know what they were doing. And because of that, if you go online and Google long-term care rate increases, you're going to see horror stories. Okay. Yeah. It's a bloodbath. People that bought this stuff in 1982 and their rates have increased by 90%. My own policy, the rates have gone up by 75%. But now, today, they have 40 years of claims paying experience. Okay. They've fixed those pricing assumptions. So you're going to pay a lot more to get into long-term care insurance today than you would have back then. But that means the rates are going to be far more stable moving forward.
That's good color. That's an interesting way to view it. I knew it's a fairly young industry or a business, I should say. But that's actually makes a lot of sense to think about. Like they got it so wrong. They've sort of corrected these pricing problems. And now hopefully going forward, pricing is more stable.
So the Society of Actuaries, all right, actuaries, these are the guys that the CPAs made fun of in high school, okay? In 2015 came out with a study that if you've got a long-term care insurance plan that was rated, priced 2014 or later, there's only about a 10% chance it's ever going to need a rate increase. Okay. And if it does, it's going to be this small, okay? I've helped probably 250 client couples through rate increases over the last 17 years. I've had one couple cancel their policy. Okay. you can manage these rate increases if you know how to do it.
Yeah.
It doesn't mean they're fun, but you can get through it.
Yeah. Good question. I was just about to ask. You step back briefly. The hybrid. We kind of throw that term around.
Yep.
What is it in layman's terms?
So you're going to hear hybrid. You're going to hear combo products. You're going to hear asset-based long-term care. Okay. These are life insurance policies. They're built on a universal life chassis, or in one company's case, a whole life chassis. So you're buying a life insurance policy that has a tax-qualified long-term care rider attached to it. Okay. These things stink as life insurance. Okay. One of the best hybrids on the market right now is Nationwide. Okay. There's Nationwide, Securian, Lincoln Financial's Moneyguard. You've got Pacific Life and State Life. Those are really the 5 carriers in the market. Okay. 5 good carriers. If I buy a Nationwide policy with a $100,000 single premium, a lot of these can be funded with a single premium. So you've got money sitting in a CD. You're not doing anything with it. You're just going to move it over to this life insurance policy. Okay. Well, I bought $100,000 worth of life insurance. My death benefit's going to be $100,000. Okay. It stinks as life insurance, but that's not why you're buying it.
Yeah.
You're going to, by the time you're 85 with that policy, you're going to have $600,000 that you can use for long-term care. But if you never need long-term care and just go to sleep some night, somebody's getting that $100,000 back.
They get,
they
get something out of it either way. Yeah. Okay. About the coverage, the benefit period, does it ever reset? I know you said you can pool it and share it with one of the riders, but.
So remember, the 3-year benefit period only matters if you were to use the full benefit amount every day, day after day after day after day with traditional long-term care. But let's say that I have got a 3-year period. I've got let's just say a $200,000 bucket of money when I go on claim. If I use $100,000 and then recover to the point where I don't qualify anymore, that remaining $100,000 is always going to be sitting there. Okay. But if I use up my entire 3-year bucket of money, whether it takes me 3 years or 5 years or 7 years, once that bucket's empty, then I'm done. My benefits are exhausted. Yes.
So why do they even bother calling it a benefit period and just say you have a pot of money?
Marketing, I guess. I don't
really
know.
Okay. It's interesting. I guess this is in reference to home care.
Yep.
Are they on alert 24/7? And if so, I would assume that increase the cost. How is that managed? Is there a night nurse?
Well, now, first of all, the 24/7 home care situation usually is going to be a family member there. Okay. Because most people who need 24/7 care, if they don't have any family around, they're going to be either in assisted living or a nursing home out of necessity. Okay. Mm-hmm. Now, yes, if you have a 24/7 care need, that's why the local home care agency is going to schedule those shifts for you.
Okay.
So it's not going to be the same Now, you could do the whole, I'm going to hire an independent RN to be my 24/7 live-in caregiver, but then you're an employer. So you got to deal with employment issues and tax issues and all of that nonsense. So I'm not a big fan of that in many cases.
Would that still, it complicates it, but would that still qualify as coverage where your benefit amount could apply towards whatever you have to?
Definitely.
Okay. Great. Who decides when the elimination period actually begins?
Who decides when it begins? Okay. Well, it begins when you need help with 206 ADLs or you're severely cognitive impaired. Now, the only thing I didn't mention earlier is it has to be a chronic situation. Okay. That just means that the illness or disability is expected to last at least 90 days.
Okay.
Okay. That just means for a broken leg, you're not going to go on claim for long-term care because you're going to be back on your feet well before 90 days. So who decides when that begins? Typically, the carrier is going to take a look at your medical records. They may require a face-to-face assessment, although that's not nearly as common as it used to be. Usually, it's just going to be medical records and a discussion on the phone.
Okay. And is it as soon as they say, okay, yes, we agree, you're not able to do 2 of 6, start now, like go. It's like that basically? Yeah,
pretty much. I mean, benefits are typically going to pay a month in arrears, okay? Because remember, I've got to send in the receipts and then they're going to reimburse me for my expenses. But I had a client, this is kind of, if I can take just a couple of minutes.
Sure.
I had a client I sold long-term care insurance to probably 15 years ago. And I was talking to her. I stopped by her. I called her. I said I wanted to have coffee. I stopped by the house and we talked for maybe 45 minutes. And I asked her if she got out much. And she said, well, no, but Sally, I can't remember the girl's name, Sally or Amber or whatever it was, kind of keeps me in touch with the world every day. And I said, well, who's Sally? Well, she's the woman that comes in the mornings to help me. Well, to help you with what? Well, I've got a good walk-in shower, but I don't feel comfortable getting in and out anymore. So she's here with me in the mornings. Well, she didn't realize that she needed standby assistance with bathing and dressing. We had her on claim 3 weeks later.
Okay. Wow. For who knows how long she was kind of giving up those benefits, right?
Yeah, exactly.
Yeah. Huge question. I'm sure this could be an hour-long discussion in itself. Pros and cons of self-insuring instead of purchasing long-term care.
Oh, this is one of my pet peeves. First of all, you cannot self-insure. Okay. When you insure, you transfer the risk. You can self-fund, but that's a long call from self-insuring. Okay. Technically, okay.
Right.
Here's what I've run into even with wealthy clients. If you've got $4 million in CDs and a $19,000 a month pension, you don't need long-term care insurance. But here's what I've run into several times over the years is dad needs 24/7 care because he's got Parkinson's or he had a stroke or whatever. Okay. They've got plenty of money in the bank, but mom's not going to spend their money on this kind of nonsense. So she's going to take care of dad. And she runs herself ragged. And before you know it, she's in the hospital because her health has gone down the tubes while their money's sitting in the bank. So the big con is, do you want to spend your money on this kind of miserable stuff? Or would you rather spend somebody else's money on this?
Yeah. Got it. So even though you may have the funds on paper and in projections, do you really want to be using it for this? Right. Or, okay. Yeah.
And look at it this way. You've got people on the call right now, Andy, who could tell me within probably $20,000 how much it would cost to replace their house, and they could probably write a check to do that. But I bet you $1 they're still insuring their house. Yeah.
Yeah. Right. That's a good point. It's a fair way to look at it. And I like the terminology. Admittedly, I say self-insure, and I know what you mean. I know where you're coming from. So when you insure something, you're transferring the risk to someone else to deal with, right? Exactly. So in that sense, yeah, self-insure is the wrong term. I like I'll start calling it self-funding going forward. That makes a lot of sense. Okay. Here, for those who are uninsurable, can you comment on guaranteed issue long-term care policies? Whatever. Hopefully, you know what True Freedom is.
I know what True Freedom is. I've poked around the edges of True Freedom. True Freedom is sort of a membership, if you will. It's not a long-term care policy. It's a bunch of guys who used to work in the long-term care industry way back when, and they said, we need an answer for people who cannot get long-term care insurance.
Okay.
So with them, what you're kind of doing is you're throwing your money into a pool sort of as a member of this exclusive club that'll take just about anybody who doesn't already need long-term care. And when you need long-term care, help with your ADLs or whatever, instead of calling the local home care agency, you call True Freedom. They, in turn, schedule your care through the local agencies and they pay for it.
Okay.
It's a little bit more complicated than that, but that's the gist of it. And I have to be honest, I've never used them. I've pointed a couple of clients in their direction, but I've never actually pulled the trigger on one.
Is this loosely comparable to health sharing, like the medical insurance alternative, where typically it's faith-based or something? It's not really insurance. It's a bunch of people of some common interest pooling money that agree to pay for one another if and when services are needed.
Pretty much, but okay. Once you send them in your annual premium, your annual membership fee, you're done with your sharing.
Okay, got it. Yeah. There's no additional. Yeah.
So they're just pooling the funds and hoping that, not too many members need long-term care. And then now what this probably does give them, though, Andy, is some bargaining power with the local agencies. We're going to send 10 people your way over the next 2 years. Why don't you give us instead of $30 an hour, charge us 26? So that might be how they're kind of hedging their bets.
Interesting. So maybe something to look into for those who are truly uninsurable and do want the protection. Okay.
Well, and can I get off track here for just a second?
Yeah, please.
On this uninsurable, there are a lot of things there are a lot of ways to pay for long-term care before you get to the long-term care insurance. Okay. Remember that. I mean, you've got savings, you've got home equity, talk to your attorney. If you're uninsurable, and even if you are insurable, you should be talking to an elder law attorney about, hey, what can we put in place from a legal standpoint to protect us? Because there are other ways to do this. Long-term care is just one tool in that whole big portfolio of stuff.
Yeah. Sort of, I guess, related comment about kind of asset protection, but what do you consider the investable net worth thresholds for spending down to Medicaid, purchasing long-term care coverage, or self-insurance, self-funding? Yep. Do you have a range in mind? And sort of quasi-related thought, do you ever advocate or work with people or have methods or places to point people who do want to shield assets from having to spend down, get them out of their name while they're alive.
Yeah, that's where the elder law attorney comes in. And again, make sure you're working with a qualified elder law attorney. Okay. So to the question, in my mind, you should have a fairly decent asset base before you're considering long-term care insurance. Okay, if you're living on Social Security and you've got $100,000 in savings, you shouldn't be buying long-term care insurance. All right.
Okay.
If you've got $1 million, anywhere from I'd say $200,000 to $1 million, you really need to strongly consider having some kind of long-term care insurance in place. Remind me to talk about the long-term care partnership program, because nobody knows about the long-term care partnership program. Okay.
Making a note.
Yep. $1 million and more. I work with some financial advisors who've got clients in the $5 million range who still tell their clients they should have it. I'm working right now with clients who've got $12 million in investable assets, but they've both had a parent with Alzheimer's. So this question, there's so much more than what's the range, okay? And what's your income? What are the sources? All that stuff.
Another consideration I come across is, what are your legacy goals? If you have $3 million, but you want to make sure you leave at least $2 million for whoever,
right?
You need to protect it, right?
Exactly. Okay. Or replace it, one or the other.
Yeah.
So can I talk about the long-term care partnership program for just a minute?
Right. Yep. Good.
Are you familiar with it, Andy?
I'm not.
Okay. No. See, this is a criminal. Nobody knows about this program. And I bring this up because spending down to Medicaid. Okay. Mm-hmm. Here's something almost nobody knows about long-term care insurance because nobody's telling them this. Let's just talk about the averages. Okay. And on average, if you've got a couple in most states and the husband has a whopping stroke, okay, and he needs to go into the nursing home and it's a horrible situation. He's not going to die, but he's not coming home. So he's going to be in the nursing home for 4 years. All right. Okay. The wife's going to have to start writing those checks for $10,000 a month. Well, she doesn't want to do that. So she goes and applies for Medicaid. They're going to tell her, Ethel, you can only have your home, your primary vehicle, and roughly $130,000.
Okay.
So if she's got $500,000 in the bank, she's got to spend down $370,000 before they're going to help her husband financially. That's Medicaid in a nutshell. Yep. Great program. Okay. But let's say she has a traditional standalone long-term care insurance policy that qualifies for something called the long-term care partnership program. Okay. Mm-hmm. So when he goes and has his whopping stroke and winds up in the nursing home, she's not going to go to Medicaid. She's going to file the long-term care insurance claim. And let's pretend that long-term care policy has a $200,000 pool of money. Okay. So over the next couple of years, he uses up that entire $200,000 pool of money. I know this is complicated. I'm sorry.
You're quite all right.
But he uses up that $200,000 money, and then the long-term care insurance runs out, and he still doesn't have the decency to die. So she's right back where she started from. Now she's going to start writing those checks again. So now she's going to go down to Medicaid, and they're going to say, Ethel, you can keep your house, you can keep your car. You can keep $130,000, but since you had that long-term care partnership eligible policy that paid for $200,000 before you came to us, we're going to let you keep your $130,000 and an additional $200,000 of your money. So now she's only got to spend down $170,000 to get him onto Medicaid.
And I'm sorry. So which policies qualify for that?
You have to buy a standalone long-term care insurance policy. Hybrids don't work.
Okay.
It has to be filed as a partnership policy, and you have to buy the right inflation rider. The partnership's available, I think, in 43 states now.
Okay. Oh, interesting. Yeah, I did not know that.
Nobody knows about it. It's a shame.
This may sort of be the same thing. I don't know what this is. Can you comment on the Federal Long-Term Care Insurance Program?
This is the long-term care insurance program that's been designed and put in place for federal employees.
Okay.
This has been around for probably 15 years now. Initially, it was MetLife and John Hancock who tag teamed this, and they came out with a product for federal employees. Now it's just John Hancock. It's a tax qualified policy. It's a decent policy. It's very competitively priced. They've had some really whopping rate increases up to 125% in some cases because it was so competitively priced. Okay. Mm. It's a good conservatively underwritten program. It's only available to federal employees. You can't get preferred health discounts. One of the issues that the individual industry has moved to that they haven't is now, if you buy traditional long-term care insurance from Mutual of Omaha or National Guardian Life or any of those carriers, women and men pay different rates because women use a lot more long-term care. The federal program still uses gender neutral rates. So men and women are, so I'm afraid they're going to have rate issues down the road, but it's a good, solid product. Do the rates they give trend more towards what men should be or what women should be, or is it kind of split down the middle? Kind of split down the middle. A couple of things you can't do with the Fed program, though, is buy shared care, and shared care is a really important rider.
That's the pooling of the benefit.
Yeah. So the husband's got a 3-year pool and she's got a 3-year pool. If he uses up his 3 years, now he can draw from hers. And what that does is it gives them some additional protection just in case one of them needs 5 or 6 or 7 years of care.
Got it.
And it saves their money for the healthy spouse. When I talk to couples about long-term care insurance, Andy, I have 2 goals in mind. Okay. The first, keep them out of the nursing home as long as humanly possible. Okay. The second, protect the financial independence of the healthy spouse.
Right. So they're not depleted because of it. Yeah. Sounds like you already touched on this, but it's a federal program comparable to the top three companies you mentioned. I know you said you don't have that shared, but otherwise, okay.
Yep.
I know the answer is yes. I don't know who it is exactly. Is there a rating agency? Part one. Part two, who's the regulatory oversight for carriers?
So the NAIC, National Association of Insurance Commissioners, is sort of the overarching authority, if you will, and they come out with the model legislation and the model contract wording and all that sort of stuff.
Yeah.
Each state regulates the insurance companies on a state-by-state basis, and that's where the rating decisions and the rating approvals and disapprovals are made at state level.
Okay. Right. And the agencies themselves. So I'm familiar with traditional corporate ratings, Moody's, S&P, Fitch.
AM Best.
AM Best is the big insurer rating.
Yeah.
Okay.
Yeah. AM Best is really they really take a look at the company's claims paying ability, and that's what it's really all about.
Yeah. And super high level, I know you mentioned do not buy a policy from anyone rated below A.
Yep.
Can you just run through quickly the schematic? Because there's 4 tiers of A, right? And then
A, I mean any A. So A minus, A plus. Any of those carriers are going to be good, solid carriers.
So don't need to lose sleep over A plus versus A minus, as long as it's A something. Okay.
Again, as long as they're hitting all those marks, they got a solid financial rating. They're conservative underwriters, and they're conservatively priced.
Okay. How would you know that other than doing the homework and shopping around policies, like conservative pricing, for example? Again,
this isn't a plug for me. You've got to work with an agent who represents all the carriers and is going to show you all the carriers.
Yeah. And I think that's important, not just long-term care, but any insurance, right?
Yeah, exactly.
Quick educational piece. There's some companies where they have in-house employees that are called captive, correct?
Right.
They can only sell that company's in-house product versus independent or non-captive, whatever technical term is. Right. You're not beholden to sell just Northwestern Mutual, right? You work with
exactly. If I can only represent Northwestern Mutual's product, then that's always going to be the best choice.
Yeah, right. No, I'm not picking on Northwestern Mutual. That's just the first one that came to mind. Okay, great. Interesting statistic question. What is the percentage of insured who actually claim?
I wish I could answer that question. I can't. The carriers are pretty tight-fisted with that information, so I honestly don't know the answer to that.
You can just make it up. Like I said before, 70%.
7%
made up. Yeah, all right, cool. If you notice, the first time I said 60% of statistics are made up. Now I said 70. Yeah. That's part of the joke. I say it to my kids.
Here's the statistic. Everybody asks about statistics, Andy. Here's the only statistic I use when I talk to people about long-term care. And this is the nerdiest thing you've ever heard, I guarantee. It's 100% guaranteed you don't know what might happen to you over the next 30 years.
I like that, yes.
If you can refute that and prove me wrong, I'll give you $100.
I cannot. That's a good one. Bud Blower, my understanding is the premiums for hybrid policies, again, insurance that has long-term care bolted on, do not qualify for tax deduction as traditional might. Is this correct?
Wow, this audience is on it. Okay. So that used to be the case. Okay. But now some of the hybrid carriers inside the product are breaking apart the long-term care rider premiums and the life insurance premiums. So you may get some deductibility. Now, deductibility is pretty tough because it's the amount that's deductible is based on your age. Okay. If you just qualified for long-term care insurance, you're probably in good health, and tax qualified long-term care premiums are rolled into your unreimbursed medical expenses for tax purposes. So you got to hit that 10% AGI trigger. All right. Okay. Now, a couple of exceptions to that. Maybe you're a business owner. If you're a business owner, you might be able to take this as a self-employed health insurance deduction. So keep that in mind.
Got it. To the extent you have positive net income, you can deduct, premiums. Okay. Here's an interesting one. Less so about the specific insurer, but just generally older policies, versus today. I purchased a policy from Mutual of Omaha that was offered to my employer in the 80s. Should I look into purchasing a newer, updated policy? Or generally speaking, Kerry, why and when should someone consider re-upping or renewing into a new policy if they have an old one?
You almost never want to replace an old policy.
Okay.
Because those old policies are, with Mutual of Omaha, for instance, not for every carrier, but most carriers, that policy is grandfathered for tax qualification purposes, so that's a good thing. But the rates on that policy are going to be so much less than what you would buy, what you would pay to replace that today. So keep that, and if you don't think it's enough, supplement it with a smaller, newer policy. But never let that one go. It's a bargain.
Okay. Yeah, partly because I wouldn't say they got it wrong, but the underwriting, they were a little too generous with the benefits, right?
And this person was a lot younger in the 80s than they are in the 2000s. So.
Good point. I'm sure people want to know this, and we chatted about it briefly before we went live. Average cost. Now, I know, again, this is all going to depend on age and underwriting and specific bells and whistles and coverage levels and things like that. But the example here, to the extent you can come up with anything, 150 a day, 3-year, 90-day elimination, 3% inflation rider with the shared care. 3% inflation with shared care rider.
I'm going to do the unheard of. I'm going to tell you how much this costs.
Yes, do it.
I have right here, the Mutual of Omaha, best product on the market today as far as I'm concerned,
And why is that briefly? Why that versus whatever other carrier?
Because of the plan features that are built in. It's got a calendar day deductible, whereas some carriers are a service day deductible. It's got that 25% cash benefit we talked about, stuff like that, So this is an excellent question. So here's a couple age 55, male, female. They're both age 55. They're in standard health. They're not preferred health. The preferred rating on long-term care insurance is like finding a unicorn. If somebody promises it to you, run away. They're not going to get it for you. All right. 55 years old, $4,500 per month benefit, 90-day elimination period, 3-year benefit period. So they both start off 4,500 times 36 months. They both got $162,000 in their bucket of money.
Okay.
3% compound inflation. Combined cost for that couple, $4,970 a year.
Okay, so basically $2,500 per person in essence.
By the time they're 85 years old, which is really that long-term care claim hot zone because of that inflation rider, they each have $393,000 in their bucket of money to use for care.
And they can freely swap it if and when needed because they have that rider. Is there any things to watch out for or kind of catches with the rider, the shared care rider?
Well, this one doesn't have shared care.
Oh, okay. Got it.
That would take the price up a little bit more on that one. Now, that was at age 55, it was $4,970. If they wait till 65, it's almost $7,100. So that shows you the difference in the pricing by age.
Right.
Okay.
And then at what point you set up to 79, I think is the latest, and that's by law or just what the insurers choose?
Just what the insurers are willing to do. You used to be able to buy it up to 85 or 90, but not anymore.
Now, I assume the moral hazard or whatever, someone who's 79 and buying long-term care, chances are it's going to be outrageously expensive because they think they need it.
Yeah, exactly. Yeah. They're a lot closer to that claim than most people.
Yeah. Okay. Here's another again, sharp group here. Long-term care insurance premiums are qualified expenses for health savings account distributions.
Absolutely.
So you can use HSA money to pay for long-term care.
Just make sure you understand what the age-based limit is because it's based on your age. Okay.
The deductibility or the ability to pay through HSA or both?
The deductibility. For instance, if I'm between the ages of 51 and 60, the most I can deduct with eligible long-term care premium is $1,690 per person per year.
Okay. Yes. Right. I dust that off. That sounds vaguely familiar in the back of my head. Yeah.
Okay. If I'm 71 or older, it's $5,640. So again, it's based on your age when you're making that deduction.
Got it. Okay. Here's a good one. If you buy a long-term care policy in one state, then move to another state 20 years later, what happens to the policy? Is there any state dependency on coverage or anything? No,
they are fully portable. You take it up and it goes with you and it works just the same in that state.
Okay. Excellent. I think the answer is probably yes. You recommend only buying a plan in the partnership program.
For most of my clients, yeah, I don't work with a lot of multimillionaires for long-term care insurance. Again, if you've got $1 million or less, it would be irresponsible of me to sell you a policy that didn't qualify for partnership.
Got it. Related question: how much assets does the partnership allow you to keep? Is it whatever the amount of the benefit is, or is there a restriction?
Exactly. Yep. If my policy had a $750,000 pool of money that I exhausted before I applied for Medicaid, I could keep an additional $750,000 of my own assets and still qualify.
Oh, great.
It's dollar for dollar asset protection above and beyond the Medicaid spend down.
Whatever the benefit amount is that you get. Okay. Jane showed up a bit late. Maybe if we can just recap. What age should one consider buying long-term care?
When it's right for you, the average is between 55 and 58, somewhere in that neck of the woods.
Okay, so late 50s, basically.
Yeah.
And you can buy. You said yours, for Jane's benefit.
Yep.
You bought yours at like 40. Some people you can buy up to your late 70s.
Sure. Yep.
Okay. Cool. How do you find out which companies are in the partnership program?
Well, typically most states will have a web page that will tell you which carriers offer partnership protection. That might be kind of hard to find because every site is different. Again, The best thing to do is work with an agent who specializes in this, and they'll know.
Okay. I just came up with my own question. You said they're portable. Policies are portable by state.
Yep.
Now, does the underwriting and the premium price, is that dependent on the state in which you get it? So like me living in a suburb in New York City, right, coverage is more expensive than Middle America. So if I buy a policy now, is my coverage, my premium based on living near New York? And will it ever be revised down if I move to like?
Don't you wish? No. It's you buy a policy that's filed in your state, and it remains the same no matter where you take it down the road.
So all else equal, if I buy a policy in whatever the cheapest, I don't know, West Virginia, I'm not knocking them, but I'm just thinking, right? If I buy a policy there and I move here, will that premium presumably will have been cheaper, yet it still gives me the same amount of benefit now in New York City area?
Sure.
Okay. Wow.
Florida, for instance, for some reason has higher rates than just about any other state. So if you're living in Texas now and you're moving to Florida next year, buy your long-term care insurance now.
Right, because it is portable. Yeah. Right. Okay.
Yep.
Maybe, I don't know if you could say, what is the median cost of adding a shared care rider?
Well, let's see here. This varies a little bit from company to company. I thought I had an example here, but I guess I don't.
Now, this is a technical crowd here. When someone asks, what's the median cost?
Yeah, I know, right?
Like, come on, man.
I'm going to say probably 12 to 15%.
Okay. That's good. Good to know.
And it's money well spent.
Yeah. I guess the answer is it depends, but should you buy prior to 55 for lower premiums? The downside is you're paying longer, but cheaper premiums. Kind of what's your thought? Is it whatever makes sense?
As long as it makes sense for you. Like I said, my wife and I bought it at age 40 and we've had 70% rate increases. Okay. Unum's no longer in the business, best policy on the planet. So we have plans right now that would cover $220 a day, 6 years each with 5% simple inflation. So pretty generous plans.
Yeah.
Combined, even after all the rate increases we had, we're paying $2,400 a year. So it's ridiculously inexpensive because we bought so young. Now, another thing that you might want to consider is there's one company out there today on the traditional side of things that will do a 10-pay. So instead of buying this at 55 and paying for the rest of my life, I'm going to pay a higher premium, but I'm going to pay for just 10 years and then I'm done and I'm covered for the rest of my life.
Fully funded at that point after. Okay. Interesting. I didn't know that existed for long care. It's good to know.
It used to, a lot of carriers used to offer it, then they all stopped, but we have one company now who's reintroduced it.
Yeah. And this is something we had chatted about before going live. I think it's helpful to mention. So you had said you generally don't recommend trying to fully insure the entirety of an anticipated long-term care, partially self-fund, partially insure. Can you just discuss that and kind of rules of thumb to the extent there are any about coverage to typically consider, coverage amounts to consider? Sure.
Again, you should be sort of in a financial position where you could self-fund a pretty good chunk of this if you absolutely had to, but you don't want to, okay? Keep in mind that in 2019, 70% of long-term care insurance claims were for home care. Yep. Less than a third of long-term care benefits are paid for nursing home care, but those tend to be cognitive claims in a lot of cases, okay? And those are the really expensive ones. So I'm going to help, or a good agent will help you build a safety net that's really going to focus on covering most of a home care or an assisted living facility stay, because that's going to help you stay out of that nursing home as long as possible.
Yeah.
And it boils down to this: you're the one that's got to be comfortable writing that check to the insurance company every year. Okay, I can show you a plan. If you're a couple age 60, I can show you a plan that's going to cover everything, and it's going to cost you $35,000 a year. If you want that policy, I'll be at the house tomorrow and we'll do the paperwork. But I'm guessing you don't want that policy.
Yeah,
I can show you a plan that's going to cost $1,000 a year, but it's not going to cover anything. It's really a balancing act. So for most people, we're going to build them a safety net that's going to supplement their own assets and cover most of a good home care or assisted living facility stay.
Okay. Yeah, that's good insight. This person clearly knows what he or she's talking about. Are all hybrid policy premiums locked in since they are single pay or 10 pay, meaning you pay it in full over 10 years and you're done paying? And I believe some hybrid, like Moneyguard policies, have no elimination period. Is that correct? Do you consider that much of an advantage compared to a 90-day elimination?
So yes, hybrid policies are fixed premium policies. They cannot change the premiums on those policies, but again, you're going to pay more. If I showed you the policy, the standalone policy for the couple age 55 was going to cost $4,900 a year, right?
Yep.
If I want to put a couple in the hybrid policies, they're going to have to buy separate policies, and if I want to get an equivalent benefit, they're going to pay $5,000 a piece per year. Okay, so it's guaranteed, but it's also more expensive to begin with because they're selling you life insurance.
Yeah.
Some hybrid policies do have a 0-day elimination period. Moneyguard has a 0-day elimination period. Moneyguard is a reimbursement policy, just like traditional long-term care insurance. Okay, so that's its weakness as a hybrid. It doesn't give you that cash benefit.
Okay.
Securian has a 90-day elimination period. Nationwide has a cash benefit and a 90-day elimination period. But once you're eligible for benefits, they pay back to the beginning of the elimination period. So there are every product is a little bit different. You just got to make sure you understand how the one you buy works.
And that's the value in an agent, and not saying this to self-promote you, but like insurance is so complicated, and across carriers, what's basically the same product will have so many tweaks and bells and whistles and different marketing names. It's literally impossible for a consumer to do the homework and do the comparisons themselves with any insurance product.
The only thing worse is Medicare.
Oh God, yeah. Quick pat on the back. Great answers, Kerry. Thank you for great info.
Thank you, Tony. You're welcome.
Sure. And I'll be sure to share at the end. Once we wrap, the thank yous come flooding in, and I'll slap them up here for you to see. All right, so we are at 9 o'clock. There's still a handful of questions. You got? I don't want to take up too much of your evening here, Kerry. Let's see what else we have. If you have an unlimited coverage policy with no term limit, do you ever recommend putting a term limit on to lower premium? I'm
a big believer in short, wide policies as opposed to long and skinny policies. Okay. I'd much rather sell you a $200 a day benefit with a 3-year benefit period than a $100 a day benefit with a lifetime benefit period. Okay. Because I don't want you to go broke while money trickles out of that policy. And very few long-term care claims are going to last longer than 3 years. So buy a short, wide policy. Don't buy unlimited coverage. It's overkill.
Okay. Good to know. Are long-term care policies protect in case they go bankrupt, like some sort of guarantee or backstop system?
Good question. And I can't bring this up unless somebody asks it by law. So that's a good question. Every state has a state guarantee trust fund of some kind. And what that is all the life and health insurance carriers that operate in a state have to pay a premium tax on everything they sell. That goes into a pool that's designed to protect consumers in case an insurance company goes bankrupt or into receivership. Okay. If that happens, depending on the state you're in, you're going to be protected. In most cases, it's up to $200,000 or $300,000. It may not protect the full benefit, but yes, there is a safety net. Okay.
And I guess similar to how banks have FDIC insurance up to some amount, pensions, private pensions have the Pension Benefit Guaranty Corp. You may not get 100 cents on the dollar, but your pension program has to pay a little bit of premiums into this national safety net that will step in if and when a particular program or a provider goes bust. Okay. Are there any level premium policies?
The hybrid policies are all level premium policies. The standalone policies, no. But again, because they fix the pricing assumptions and they're so much more expensive today, I tell my clients, look, you're 55. You're going to buy this policy. You're going to keep it for 30 years, 40 years maybe. You're going to get a couple of rate increases, but they're going to be this big, not this big. Okay. And even when you get that rate increase letter, if you have to, you can tweak your benefits to keep your price down.
You can. So they do allow you to change. Okay. That's interesting.
You have the contractual right in every policy, every tax qualified policy out there to adjust your benefits at any time for any reason. It doesn't have to be because of a rate increase. There's also something called contingent non-forfeiture. Okay, again, one of the things that nobody knows about. Contingent non-forfeiture is a consumer protection feature. It's built into all of these policies that says if your rates are increased by a certain percentage based on the age when you buy it, if you hit that trigger percentage, you can say, you know what, the heck with this, I'm done. I'm not going to pay any more. Whatever you've paid in premiums up to that point, even if you let the policy lapse, would always be there for you to collect in the form of long-term care benefits.
Oh, great. Okay.
That's built into all these tax qualified policies. But again, since today's policies are so conservatively priced, nobody buying a policy today is ever going to have to worry about that, in my opinion.
Yeah. If you want to find out more about ratings, where do you go? Is there a central site?
You know, that's a tough one. You can go, if you know which carriers you're looking at, you can usually go to their website and they'll have an investor section or a financial section, and they might have those ratings in there. Other than that, again, if you're working with a good agent, he or she should be able to provide you with that.
Okay. When do you stop paying premiums? Is it based on the amount of coverage divided by number of years? Or I guess another way, some policies you pay forever until you use it or die, right? Most
policies you pay forever or until you go on claim. Typically, once you're collecting benefits, your premiums are waived. Okay.
Okay.
But unless you buy a hybrid with a limited payment, like a 5 or a 10 pay, or a single pay, or you buy the one traditional long-term care policy as a 10 pay or a single pay, you're going to be paying pretty much forever.
Okay. I don't know what this means. We bought a long-term care policy with John Hancock a decade plus ago and has level premium, daily coverage, $225. Is this a corner case policy? Do you know what that means?
I do not know what that means, a corner case policy. It's a John Hancock policy. It's a good, solid carrier, and you got a $325 a day benefit. You've got a good, solid plan there. I'm not sure what you mean by, is it a corner case policy?
Okay.
No, sorry.
Maybe like unicorn, unusual, hard to find. I don't know.
You couldn't replace it now for anywhere near what you're paying for it, I guarantee you.
Is Hancock still currently underwriting new policies or no?
Just for the Fed program.
Okay. Do any policies refund part of your premium if you never use it?
One company, National Guardian Life, will sell you a partial return of premium rider. So if you buy this policy, you pay the extra premium. When you pass away, your premiums minus any claims paid would be returned to your estate.
Okay.
Typically not worth the additional premium. Again, I'm not a big rider guy unless it's going to give you a real tangible benefit. So.
Okay. This is super helpful. Thank you. All right, looks like we are getting towards the end here. Cody Garrett as well. He's actually one of the moderators of the group and a very active contributor. You've been such a helpful guest, Kerry.
Hey, thank you, Cody.
Oh wait, here we go. Apologies if this has been asked. I'm late to the party. What? Oh yeah, okay. The age question again. Recommended age, late 50s, typically, right?
Mid to late 50s is when most people are doing it.
Okay. And the last question I see: do long-term care policies cover care outside the U.S.?
That's a good question. Maybe. Most carriers do, some carriers don't. That's really where you've got to look at the specific policy. For instance, if you said you wanted a traditional long-term care insurance policy and you might be receiving care outside of the U.S., I would point you at Mutual of Omaha. If you wanted a hybrid policy, the life and long-term care rider, I would point you at Securian. Those are the two strongest right now for international benefits.
And those that do have international coverage, do they cherry pick the countries they cover and with different coverage amounts, or does it kind of applicable wherever?
For instance, Mutual of Omaha will pay you. Now, remember, Mutual of Omaha is a reimbursement policy, okay? Yeah. But if you're outside the U.S., they would pay a cash benefit for up to 1 year. And if you wanted anything beyond that, you'd have to come back to the U.S.
Okay.
So
got it.
Yeah.
Okay. Lots of thanks flowing in from everyone. So it looks like we're calling it. So Kerry, whoever this is, planted this perfectly. If people want to reach out to you, find out more about your services, long-term care, where do they go? How do they find you? Okay, so I'm part of a large agency. The website is clarkinsurance.com, CLARK insurance.com. Okay. My email is just kpeabody@clarkinsurance.com. If you're on LinkedIn,
look me up on LinkedIn. I've got about 45 really good articles out there that you can read if you want to nerd out a little bit more on this stuff.
Okay. And this is your email, right? Peabody at clarkinsurance.com. And so you are in Maine, sorry. Which states are you able to work in, or clients in which states are you able to work in?
Right now, I'm licensed in about 26 states.
Okay.
In most states, if I'm not licensed, I can be licensed in a matter of a few days. So not a big deal.
And to the extent you're not or can't, do you have someone else within Clark, or like what would you do with someone for whatever reason you simply can't work with? Where would you put them?
From my old Unum days when I was flying around the country training agents, I've got contacts pretty much anywhere. So we can, if I can't help you, I'll find you somebody that can. Okay.
Awesome. Great info on a complex topic. Thank you. Fantastic info. Thank you so much. Great information. Wish we weren't uninsurable. Sorry to hear that.
Now hold on. Call me. There may be an answer. Okay. Again, if you want to get creative, there are different products out there that we might be able to do something. At least take the time to make sure you're uninsurable before you just assume that you are.
Right. And thanks to Cody Garrett, just giving people a splash here of your LinkedIn profile. All right. So we're going to wrap it, Kerry. Super, super helpful. I learned a tremendous amount myself. So thank you for your time and your knowledge.
Thanks for having me.
If you could just ask you, stay on the broadcast, I'm going to kill the live and then just stick around for a while. So well, hold on. One more straggler just came in. If I don't know if I will be in the U.S., would you still recommend long-term care or just consider other types of products like annuities?
We'd have to talk. It depends on where you're going to be, why you're going to be there, how old, all of that stuff. Again, there are other ways to pay for long-term care than long-term care insurance. It may not make sense for you. I'm happy to talk to you if you want to talk.
Okay, awesome. All right. Thank you all. It's been a pleasure. Thank you again, Kerry. Take care. Good night.
Bye-bye.